Alphabet just brought in nearly $110 billion in a single quarter. But, if you look closely at their bank accounts, the actual free cash they have left over was essentially cut in half.
Yeah, it is a massive financial paradox.
Right. And welcome to the deep dive. Today, we are figuring out why one of the richest, most profitable companies on Earth is suddenly borrowing billions of dollars just to, well, buy servers. Our source today is Alphabet's Q1 2026 earnings report.
And our mission here is to really unpack the numbers behind the hype.
Exactly. We want to see if the massive hype around artificial intelligence is actually generating real-world, sustainable profits for you, the potential investor or observer.
Because this isn't just like a routine financial spreadsheet. For anyone watching the tech sector, this document is the definitive scorecard. We're looking at their 11th consecutive quarter of double-digit growth.
Which is wild.
It is. They hit $109.9 billion in consolidated revenue. That's a 22% year-over-year jump.
Okay, let's unpack this. Because if Alphabet is like a massive cargo ship, we aren't just looking at how fast it's going, right? We're going down into the engine room to see what kind of fuel is burning to create this much speed.
I like that analogy. And to understand the fuel, we first need to look at which specific engines are doing the heaviest lifting.
Right. So I was looking at the breakdown of their primary business lines, and the growth rates completely upend the old idea that Alphabet is just a search engine company.
Oh, absolutely.
If you want the quick summary, there are three main growth engines. Number 2 and 3 are the legacy ones. You have their traditional core, Google Search and other, bringing in $60.4 billion.
Which is still a very healthy 19% growth.
Yeah. And then you have subscriptions, platforms, and devices. That's mostly fueled by YouTube and Google One. That segment hit $12.4 billion, also growing at 19%.
And they just crossed 350 million paid subscriptions.
Right, a massive user base.
Yeah.
So search and subscriptions are humming along at 19%.
Yeah.
But then you look at Google Cloud, which is their #1 growth standout.
Right. The cloud division is just on another level.
It really is. Cloud didn't just grow. It exploded by 63% year over year, hitting $20 billion in revenue for the quarter.
Yeah, $20 billion. And what's crucial here is that their overall operating margin expanded to 36.1%.
Which means that they aren't just selling more, they're operating significantly more efficiently.
Exactly. They are keeping a larger slice of every dollar they make.
But let me push back with a specific question here. When a company as mature as Alphabet suddenly sees a legacy product like Search jump 19% and a newer product like Cloud just explode by 63%, what is the common denominator?
Right.
Like, is it just a really good economy, or did they fundamentally change the recipe?
It's definitely a change in the recipe. The common denominator across all three of these engines is Alphabet's full-stack integration of AI.
Yeah.
Sundar Pichai made it very clear in the report. They aren't selling AI as a quirky add-on feature anymore.
So it sounds like AI is no longer a separate feature you buy. It's the electricity powering the entire house.
Precisely. If you use Google Search, you're interacting with their AI models behind the scenes, synthesizing better answers, and that's actually driving search queries to an all-time high.
Oh, wow.
Yeah, more queries mean more opportunities to show relevant ads. So that explains the 19% growth in search.
All right, that makes sense.
But the 63% explosion in cloud, that is happening because other businesses are paying a premium to build their own software on top of Google's AI infrastructure.
Which brings up a stat from the report that is just, well, it's hard to wrap your head around.
The token processing.
Yeah. The report notes that Gemini, Google's primary AI model, is processing over 16 billion tokens per minute via direct customer API use.
It's a staggering number, and that is a 60% increase just from last quarter.
Wait, 60% one quarter?
Yeah.
Wow. But for anyone listening who isn't deeply entrenched in software development, help us understand the sheer scale of what a token is in this context.
Sure. Think of a token as the fundamental unit of computation for an AI. It's roughly equivalent to a piece of a word or a line of code.
Right.
When an enterprise sends a token to Google Cloud, the AI has to process it, understand the context, and generate a response.
Right.
So doing that 16 billion times every single minute requires an unfathomable amount of raw computational power.
It's just wild.
It means that by the time we finish this sentence, entire libraries worth of data have been ingested, analyzed, and returned to thousands of businesses globally.
And we are seeing that stickiness in the numbers, right? Because Gemini Enterprise saw a 40% quarter-over-quarter growth in paid monthly active users.
Exactly. And it's not just happening in the digital realm. The report highlighted a major milestone for AI in the physical world, too.
Oh, Waymo.
Yeah, Alphabet's autonomous driving bet, they
Yeah.
just surpassed 500,000 fully autonomous rides a week,
500,000 rides a week with no human in the driver's seat.
which proves they are successfully taking the AI out of the data center and applying it to real-world physical logistics.
But getting back to the enterprise side, how do we know customers are actually willing to pay premium enterprise prices for this AI electricity?
Well, that pivots us directly into what might be the most stunning metric in the entire report.
The backlog.
The Google Cloud backlog, yes. As we mentioned, Cloud hit $20 billion in revenue, and its operating margin nearly doubled from 17.8% last year to 32.9% this quarter.
That's a huge jump in profitability.
It is. But what's fascinating here is the backlog. This is the pipeline of signed contracts for future services.
Right.
It nearly doubled quarter over quarter to over $460 billion.
$460 billion in future commitments. Let's just pause on that for a second.
Yeah, it's almost $500 billion.
That is enterprises standing in line, waiting to use this technology.
It's essentially guaranteed future business. It's locked in by corporations and governments who know they are heavily reliant on Google's specific AI solutions.
Okay, but if I'm looking at a $460 billion wait list, does that guarantee future dominance? Or does it highlight a major risk factor?
Ow.
Well, if I run an enterprise and I'm on that wait list, I can only wait so long. Can Alphabet physically build servers fast enough to fulfill that demand?
And that is the exact tension defining their entire corporate strategy right now.
Yeah.
Fulfilling a $460 billion demand is a grueling global physical challenge. You have to understand, this isn't just a Silicon Valley tech boom.
Right. The geographic distribution shows that.
Exactly. This is a global enterprise modernization wave.
Because if you look at the regions, the growth is remarkably balanced. The U.S. and the APAC region, which is Asia Pacific, are the fastest growing.
Right. They both surged by 23% year over year.
Yeah, the U.S. brought in $54 billion, and APAC hit $18.3 billion.
And the rest of the world isn't far behind. The EMEA region, Europe, Middle East, and Africa, along with other Americas, both grew by a very strong 21%.
So literally the whole world is buying what Alphabet is selling at the exact same time.
Yes.
But to supply the entire globe with AI infrastructure,
Yeah.
you have to spend an unimaginable amount of money.
Yeah.
Right.
You do. Which perfectly explains their aggressive spending strategy and that cash flow paradox we teased at the very beginning.
So let's open the ledger and look at the physical cost of the AI revolution. Because for large-scale investors, this is the most critical data to analyze.
Absolutely. Alphabet's capital expenditure, or capex, which is the money they spend on physical hardware like property, equipment, and servers, it's skyrocketed.
By how much?
By 107% year over year.
107% increase. What was the actual dollar amount?
They spent $35.7 billion.
In 3 months.
Yes. In one quarter, they are aggressively buying the physical hardware needed for AI.
That is the GDP of a small country, just spent on computers and cooling systems.
And because of this massive spend, their free cash flow actually dropped. It went from $19 billion a year ago down to $10.1 billion this quarter.
Okay, so if you're listening and mapping this out, revenues are up 22%, profit margins are expanding.
Right.
But the actual free cash they have left over was basically cut in half, down to $10 billion, just because they have to buy so many servers.
That's the reality of the capex cycle right now.
But wait, I have to stop you here. Because if you just skim the headlines, Alphabet reported a net income of $62.6 billion.
Yeah, which looked artificially astronomical. It's an 81% increase.
Right. So if their free cash flow dropped to $10 billion, how does net income shoot up to $62 billion? Where did that money come from?
So $37.7 billion of that net income was from unrealized gains on non-marketable equity securities.
So it's paper wealth.
Exactly. The private companies they invest in went up in estimated value, but it's a major volatility risk factor to note.
It's like your house going up in value. You're technically richer on paper, but you can't buy groceries, or in this case, NVIDIA chips, with your home equity unless you sell the house.
That's exactly it. And market dynamics could shift, and those billions in paper gains could just vanish. So that $10.1 billion free cash flow is the true operational metric to watch.
So what does this all mean for their cash management strategy? Because amidst all this drop in cash flow, they made a massive move regarding dividends.
They did. Despite the massive capex bill, the board announced a 5% dividend increase for Q1 2026.
Setting it at 22 cents per share, right?
Yes. And on top of that, they issued $31.1 billion in senior unsecured notes to help fund corporate purposes.
Okay, let me push back hard on this.
Go ahead.
Wait, their free cash flow is basically cut in half because they're buying so many servers.
Yeah.
Yet they are taking on $31 billion in debt. A&D increasing the dividend payout to shareholders. How does that math make sense for a potential investor?
It sounds counterintuitive, but it's a very deliberate dual mandate cash management strategy.
Okay, break that down for us.
By raising the dividend, Alphabet is signaling supreme confidence to Wall Street. They are rewarding shareholders now, showing that their legacy businesses are still highly lucrative cash cows.
So they're saying, don't worry about the massive server bills. Our core business is so good we can afford to pay you more.
Right. It keeps investors happy during a very expensive transition.
But what about the debt? Why borrow $31 billion?
Because debt is cheap for a company like Alphabet. By borrowing, they preserve their actual cash on hand for agility.
I see.
But that $35.7 billion infrastructure spend, that is a defensive and offensive moat. They have to spend it to ensure they capture that $460 billion cloud backlog in the future.
Because if they don't build it, someone else will.
Exactly.
Wow. Okay, so just to recap this journey for you listening, we are looking at 22% revenue growth overall.
Yep.
A 63% explosion in cloud. We have the sheer force of Gemini processing 16 billion tokens a minute.
And Waymo hitting 500,000 autonomous rides.
Right. And underneath it all, a cash strategy that somehow balances heavy AI infrastructure spending with shareholder rewards through dividends and debt.
It is a massive balancing act. But I want to leave you with one final thought to mull over, building on all this data.
Okay, what is it?
Think about that $460 billion cloud backlog. Alphabet is currently spending $35 billion a quarter on physical infrastructure.
Right, the pouring concrete and laying cables phase.
Yeah. But once that hardware is built and paid for and the capex cycle finally stabilizes,
Yeah.
what happens to Alphabet's profit margins when they are effectively acting as the foundational utility grid for the entire global AI economy?
Now, when the Hoover Dam is fully built and everyone just has to pay for the water,
Exactly.
that is a fascinating long-term prospect. Well, thank you for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we will catch you on the next one.